Colin Cattell with Palisade Radio. We're delighted to have Frank Holmes of U.S. Global Investors join us for an interview today. Frank, thanks for coming on the program.
Well, it's good to be here.
The TSX Venture has recently seen a nice lift, crossing above the 200-day moving average for the first time in 3 years. And in a recent post, you described that we're poised for a golden cross. For some of our listeners that don't know what a golden cross is, can you describe that phenomenon and touch on what it would represent and why it would be potentially bullish development for the mining sector?
Sure. Well, the golden cross is a cross that's basically on moving averages with the theme that the trend is your friend. And quite often, if you go to Bloomberg or Yahoo Finance, the default buttons for moving averages are the 50-day, which is a medium-term moving average, and the 200-day, which is 10 months. So whenever the 50-day moving average, which is the past 6 weeks, goes above the past 10 months, that is called the golden cross for any type of a major asset class like gold or the Vancouver Stock Exchange Index. And the reverse of that, when the 50-day goes below the 200-day, that's called a death cross. And historically, markets become very volatile and trend lower when the death cross takes place. And if you look at the visual we showed, that when gold peaked at 1900 and then started to fade from there, the death cross took place and the Vancouver fell for almost 3 years. So I think that's what's important, and you've had a decline like this, which we experience in natural gas also. And natural gas prices have now gone through $5. It's not been a straight climb, but the golden cross for natural gas prices took place over a year ago. And it's been a slow, steady climb, and that climb from basically 2 and change to over $5 has been ignored almost in the marketplace of people appreciating that rise, and now you're starting to see gas stocks start to have huge moves. I think the same thing can happen with the Vancouver, which is predominantly junior mining and oil and gas energy stocks. So the energy stocks in Canada also have been under the weather, for no pun intended, for the past 3 years.
This leads us to your contention of the chance for a major gold rally. What does history tell us about the chances for a major gold rally in stocks based on where we are in the market now? And are we poised to see something sharp or a nice, long, slow move up?
I think a nice, slow move up, almost like what took place with the natural gas prices coming off their lows, which is constructive and is positive. A quick euphoria all of a sudden could quickly eliminate itself. Now, what's interesting for your listeners is that we love probabilities. We love card counting. You can't do it in Vegas, but you can do it in capital markets. And what we find is interesting is that only in 3 decades, only 3 times have you had gold stocks, big cap to micro cap, fall for 3 years in a row. It's unprecedented that the HUI, the XAU fell for 3 years. Now, bullion had its first decline in over 12 years, but the gold stocks have been in a gradual, painful decline. It appears that they're bottoming also. And I think you're seeing many CEOs in the big senior mining companies lose their jobs. You're seeing big shakeups. You're seeing delays in a lot of operations, etc. And I think going forward for these junior mining companies is going to be much more constructive. People are going to be much more, diligent in asking the questions. Do you have your permits? Because a lot of these stocks, the math suggests that if they fail to be able to get their permits, the stocks fall over 50% for 18 months. So I think the juniors are going to come out of this research as the Phoenix approach in looking at these capital markets of those that are much further down in that brownfield stage, and they're the ones who get bought out.
Talk to our listeners about the major gold catalysts you've outlined for 2014. Are there any downside catalysts that could take gold down lower as well?
There's 2 big demands for gold to always respect and appreciate. The one called the fear trade gets most of the attention, and that has to do with real interest rates. What is the government paying you to lend you, borrow money from you for their 5-year or 10-year period, or short-term 90-day treasury bills? We went through 12 years of negative real interest rates, and only in this past 3 months that we see positive real interest rates on 10-year and 5-year government notes, not on Treasury bills as of yet. So that means that the government's going to pay you more than, if inflation's at 1.5% as they allege, then they're going to pay you more than 1.5%. We think that the pressure is going to start mounting here for CPIs to get back over 2%. And we think that it's going to be difficult to have interest rates rise dramatically. So therefore, you're going to see gold become more attractive for that fear trade. Now, 60% of demand, it's so important to appreciate, 60% of the demand is what I characterize as the love trade. And that is Asia, the Middle East, Turkey, China, India. This whole region of the world believe in giving gold for weddings, birthdays, graduations, anniversaries, New Year, whatever it is give some form of gold as a gift. And what's important to appreciate here is that GDP per capita, that is, the average income has been rising in China and India. And in fact, for the past 18 months in India, it's gone flat. It has not been growing at an attractive rate above their CPI number. So we believe that this year you're going to start seeing an acceleration again of rising GDP per capita, in particular the second half of this year, coming out of India and China and the region. There's so much negativity right now in global emerging markets, and it just bodes well to set the stage that the governments can't raise interest rates domestically greatly, and they won't do it quickly, otherwise you'll see another big recession take place. And we believe that they're going to continue printing of money, and this basically should bode well for these countries.
How does the recent ban on gold imports in India affect the love trade coming out of the East?
It's definitely impacted, especially in the second half of last year, the gold going into India. But what I think is also important is the gold that's reported. I think there's so much more gold actually being smuggled into India, and that's what the government really wants. Before they were having the post office sell gold, you could buy it at every bank, etc. Now the post office stopped selling gold, therefore they stopped recording it. Banks stopped selling gold, they stopped recording it, therefore it doesn't show up in their current account deficits, and it makes their current account deficit look more attractive. So if you're not recording it, it makes it easier for them. I think that that's the process that's going on. I think the DNA of the cultural affinity for giving gold is not going to change. More important is the consumption of gold for this love trade is the GDP per capita.
And before we hit record on this interview, we had a discussion about the PMI. How does a rise in the PMI relate to commodity demand globally?
Great question. I wrote about this in a Frank Talk in December, and there's a very compelling data on the purchasing manufacturer. They call it Purchasing Managers Index. In the U.S., they call it the ISM Index. And politicians love to track this because it's highly correlated to creating jobs, good-paying jobs. And for us, it basically says that manufacturing is picking up. Not only are they picking up jobs, but they have to consume more metals to make their products. And then to have the electricity to manufacture their products, then they have to consume more coal for energy or gas for energy or oil for energy. And this all bodes well for the overall demand for resources. And what our research has shown that every time the 1 month goes above the 3 month, for the global PMI, that is Europe, China, India, America, all of them collectively added up, when the 1 month goes above the 3 month, all of a sudden you start seeing a rise in commodities. And the data points are quite compelling. Basic materials of the S&P 500, one of the key 10 sectors, it is a 77% probability of rising. It's an 85% probability of the S&P energy sector rising. There's an 86 or 89% probability for copper prices to rise. 77% of the time, oil prices rise. So I think that's what's important to be able to track. And then last week we saw the PMI start to slow down for China, and this immediately we saw the S&P sell off. We saw the cyclical stocks, the industrials, et cetera, everything sold off, worrying that the global PMI reverse itself. It's not going to go up. But on the other note, we saw rates drop in the U.S. the 30-year, the 10-year, the 30-year mortgage rates dropped, which is good for housing. So you have this sort of job creation. So I believe the government's trapped. It really can't see rates rise rapidly because the sensitivity, the spare capacity would trigger a recession. So we're going to live with low interest rates. And I think we're going to see the governments do everything to get this PMI modestly rising again, and this bodes well for all commodities. In particular, we take a look at energy and copper.
And here at Palisade Radio, we're very focused on commodities, in particular precious metals. Can you provide some specific stocks you're looking at or favorite metals to buy? If Frank Holmes had a big chunk of cash sitting around right now, what in particular would you buy?
Well, when it comes to just, let's say, our gold funds, our world precious minerals, it looks at companies that have a DNA that they have to be in the top half in growth and production, and the bottom half of a cash flow multiple to pay for it, and have to have a margin. A lot of the gold mining companies have experienced no margins, and they've way underperformed. So that's where our focus would be. And what really is glaring to big cap investors is you buy Franco-Nevada, you don't buy Newmont. Franco-Nevada has a gold royalty with 80% profit margins, none of the headaches, on all of Newmont and Barrick's operations. And they pay monthly dividends, which are higher than a one-year government bond. And management owns a big slug of the company. So I think you own Franco-Nevada. I think you own Royal Gold, another royalty company, and Silver Wheaton. Silver Wheaton has the highest profit margin and revenue per employee in the world. They're throwing off hundreds of millions of dollars every quarter of free cash flow, and they have a model that as silver prices rise, their dividends rise with it, and so they have buckets of cash in their balance sheet, they have huge free cash flow, and they have less than 40 employees. I mean, you're talking about a over $7 billion company. I think that they're important companies to have in that portfolio. Now, when it comes down to the junior end of companies, you want to have companies that could be bought out, could be strategic. And so we look at Cisco. We had a big position in Cisco, and it recently was bought out by Goldcorp. So we're trying to look for companies that are in that position. We love Virginia Gold. That's in Quebec. Very, very smart management. Very, very capable. A company of that nature we like in our top 10 holdings, who has really truly hardworking management. Ralph Aldous always talks about is the people behind Comstock. So he admires them. One of my biggest disappointments looks like it's finally turned the corner, and it's called Gran Colombia. It's a company that produces over 100,000 ounces in Colombia, and so they've had huge restructuring and hired a new CEO that went to Stanford. He's from Venezuela. He's an engineer, and he's lived in the U.S. and also understands Latin America to take over that ship. So I think if you did a re-rating on that on a relative basis, the stocks can triple from here. So we like stories like that where you have good management, and that's a real key factor. There's an old expression, it takes a man to make a mind, not find one. And the key is to find that person who's built the mines, knows how to operate, and I think that there's very few actual companies that we have a tremendous amount of credibility in the management. The other the biggest gold producing company that we have a lot of confidence in management would be Randgold. More so than a Newmont, more so than a Barrick. The CEO shows up at every gold conference. He's not snobby. And we're never going to see the CEO of Barrick showing up at one of the gold shows. You're just not going to see it. But you'll see Dr. Mark Bristow showing up, talking to institutional investors in the afternoon and retail investors in the morning, and is very caught up with the high returns on capital model. Is very, very prudent, and he's predominantly in West Africa, and I think he's just one of those great CEOs.
Are you recommending anything in the energy sector or maybe agricultural commodities to your readership at this point?
Well, when it comes to agriculture, one of our big holdings is listed on the AIM called Agriterra. It's so inexpensive and growing. It's in Mozambique with cattle and corn co-op, etc. So that's more difficult for your listeners to take a look at something listed on the AIM market. When it comes to energy, a stock that I think is so inexpensive is a company called Pacific Rubiales. This is a 4% dividend yield. It just bought out Petrominerales, and it trades at 2 times cash flow, 2 times. And not only they increase their dividend, they're buying back their stock. Every day they're buying the maximum amount of their company back because it's so inexpensive. And if you look at the growth profile, and the range that some analysts think it's worth $18 a share up to $34 a share. We think the stock is probably more attractive, but it trades at $25. So something like that, and I think you're seeing people like Carl Icahn come in and go after Talisman and shake up that company and start selling the parts to it. I think the fact that you're seeing people of that nature coming in and look at these energy companies, Pacific Rubiales is just one of those undervalued stocks that the market owns, the stock market. The management has been diluted over time, so they do not control, they can't prevent someone like a Carl Icahn coming in.
Great suggestions for our listeners. Real pointed question for you here. Has the Dow Jones Industrial topped out finally, or do you see further rises coming in the coming years?
Well, let's talk about the presidential election cycle. Historically, the first 2 years are the toughest, and the latter 2 are the best. And so that says that the next 2 years, odds favor for a stronger stock market. The other factor is the best cycles for the stock market, the Dow Jones, is when you have a Democrat president and a Republican Congress. So that's what we have. And history doesn't matter what takes place when you have that scenario going back over 150 years of data. It's usually the odds are in your favor of rising markets. As long as interest rates stay low, I think the stock market trades higher. I think that you're seeing a complete shift in the psychology of executives. The idea of issuing stock options has dropped dramatically. Now they issue shares vested over time. And what is senior management doing? They're increasing the dividend because they benefit from those shares. And 2, they are buying back stock. And if you take a look at the data points in the S&P 500, the total number of shares outstanding has been shrinking every year. So I think that the only time it expanded was in 2009 with the bailout, late 2008, with the whole bailout of the financial sector. Many shares were issued in General Motors to AIG to the government. And then 2 years ago, they were all allowed to start buying back their stock. And what you saw was Bank of America, JP Morgan, all of them start buying back their stock and increasing their dividend. And now you're seeing the net number of shares of the S&P 500 has been shrinking for the past 3 years. So what does that mean? It means that we could see companies borrow inexpensively in the capital markets, tap the bond market, and then turn around and buy back their stock. And therefore, you're going to get rising earnings and rising cash flow per share. A classic would be IBM. IBM in 10 years, its revenue has gone nowhere. It's actually down. But on a per share basis, it's up because they bought back 50% of their company. And I think that that's a phenomenon that's taking place right now in the capital markets. So that is bullish for the stock market.
And where can our listeners go to find out more about your blog posts and following your readership?
Well, thank you. It's real simple. usfunds.com. Go to usfunds.com and log on for Investor Alert and Frank Talk. Frank Talk is most of my travels around the world and interesting facts that impact capital markets. And Investor Alert is the best thing, I think, for investors to be able to read and get a feel. It's written every Friday by the portfolio team, and it's a SWOT analysis. Think of game film analysis that pro athletes have to do. They look at the last game they played, they look at the strengths and weaknesses, then they look and plan out next week what are the opportunities and threats of the team they're going to play, and we look for data points coming out next week. I try to figure out what can impact the capital markets from just the gold funds or global resources or emerging Europe or China. So we publish this succinctly, so it's easy to read. And I think that that's a great resource for investors. And we've won 54 awards for marketing education, and we're very proud of that. And the blog has, I think, 40,000 people in 70 countries.
Well, great interview, Frank. Thanks for taking the time to join us here, and we'll hopefully have you back here soon.
Great. Happy investing.